All right, ladies and gentlemen, I hope you had a wonderful day. It was a slow start returning back from the holiday, but now tomorrow morning we hear from Jerome Powell, and I think a lot of people are overhyping it. So that's where we're going to start here today. The number one question that I got asked was whether or not Jerome Powell and Janet Yellen are going to be moving the stock market. If you're not familiar, tomorrow and Wednesday, both Powell and Yellen, they're going to alternate before the Senate Banking and House Financial Services Committees. They're going to be doing these little questionnaires that they do with all the government officials, but people are asking, is this going to be an event? So in my opinion, I don't think Jerome Powell is going to move anything. We will be hearing from him about 30 minutes after the bell tomorrow, and usually the first couple of questions and pre-written statements, that generates some headlines and people start paying attention, but unless Powell changes his tone, I am not expecting any market action out of it. In a weird way, you do not want Powell to say much, because if he does say anything that is truly new, that will be a big surprise for the market. And in this environment, people are going to have to reprice and do a lot of things. And quite frankly, Powell has had many opportunities to change tone this year, and he has not taken any of them, and he is playing that strategic ambiguity card. So keep that in mind for tomorrow, and don't forget as well, Powell and the Fed is at the end of the month. We're also going to be getting a lot more earnings, so if there's any Powell that you need to be paying attention for, it will be the Powell on July 31st. So as far as Yellen, I don't expect anything out of her. Powell is going to be the main dog, but the way these things are, it's kind of just an event where everyone's going to ask questions, and then with the election coming up and Powell hammering home an idea of what he expects from the market, he shouldn't really be changing that tomorrow. So watch out for that. That's going to be the big driver. We will get a couple of sets of data, but besides that, like I told you, it was a small day in the markets. We had a little bit of data. Some of the trends in bonds and gold, they kind of calmed down a little bit, but it was a big leader out of the chip space. Even Intel, even after hours, this thing is going nuts. It has its best day in all of 2024, and I really think this is everybody just getting ready for earnings. So we got a lot to talk about. I got the breakdown, the keys, the plays, everything we did today. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/The Stock Market. We will see you there in the morning. Run it, baby.
Walking to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
But right off the bat, you don't have much to deal with tomorrow, and even today, there wasn't that much data. We will be getting ready for Powell tomorrow, but you really felt the summer effect. The volume was extremely low until the end of the day. You spent 7 hours to trade at the same price that you opened up at, and the way the data played out and how things are looking, I'll tell you right now, this might be a bigger week for bonds and rate cut odds rather than equities. So when the data came out, equities were very sensitive today, and you started seeing all these movements, but by the end of it, everybody is looking, well, how does this factor into rate cut odds? And then are the bonds still having that rally after selling off after they had that previous rally? And why I'm bringing this up, there's been a lot of ideas going around. JP Morgan and Goldman, they were talking about yield curve uninverting trades, and then just think about it, you're getting CPI, then you're going to get the PPI, which we're going to talk about, and then you're going to get the start of earnings. The fact of the matter is, how that data plays out, if you're seeing how slow we're moving right now, chances are the data will speak more towards the bonds and rate cuts rather than disrupting the market, especially when by the end of the week, everybody is going to be responding to earnings, and then depending on the cue we get from earnings, that will decide where equities are going to go or whether or not they meander or keep melting up. up because remember, July is one of the most bullish months seasonality-wise. So that's the first key. Watch out for that. Then coming into the data, like I'm telling you, CPI is going to be the big move of the week, but don't forget about the PPI. This came up a couple of times today, and everybody is focusing on the CPI, but remember, Friday you had the non-farms. That's a big data set, and even though it missed and then there was these big revisions, you really didn't get too crazy of a reaction. Yeah, the market hit all-time highs, and that's where we're chilling out now, but like I'm saying, we have an interesting setup here. I think rate cut odds and bond yields are going to be the most important, and if you are going to watch a 1-2 punch from the data, I think that PPI coming out on Friday and then the data you're getting, the PPI from other places around the globe, that will have more possibility of moving things if we are going to get a data-driven move. Otherwise, I would fall back and go right back into earnings mode. So pretty straightforward, like I'm saying here too. It is summertime, so there's not much you have to deal with, and now that leads into the final key here. Earnings is creeping up right around the corner, but I hope you noticed it today with some of the price action. You're already getting pre-earnings pops. Yeah, the chip makers moved up, but what happened, you had people pre-announcing, you had analysts upgrading and downgrading some other names. Most of them were upgrades, and then you have these gigantic moves. So what you need to realize right here, right now, nothing is confirmed. So whatever move is happening now, this is just anticipation. This is why it's a double-edged sword, because we are still about 3 weeks out from some of these bigger companies. They may move 5-8% like Intel today, but come their earnings, all of this stuff could change. So what you're seeing now, low liquidity, a lot of activity out of the analysts. These movements are just getting ready for earnings. I wouldn't read too little into them, but I also wouldn't read too much into them and saying, oh, wow, this is how it's going to be the next couple of weeks, because everything can change. But if you're wondering what's driving things, it's not necessarily data domestically or around the world as much as it is people seeing the timeline and now positioning and getting ready for some of these big earnings, especially after some of these names have moved a lot in the quarter. So watch out for that. That's definitely the start we got to this week. Tomorrow, not much data. Like I said here, all you'll get is the oil numbers and then Powell. And then come Wednesday and Thursday, the data will start rolling in. Thursday, Delta, Pepsi, and then Friday, bank earnings. Then we're really going to start getting into it. But hopefully you're hearing what I'm saying. That's all towards the end of the week. So in the meantime, we may need a position, and then don't forget what the bond market is telling you. But besides that, it's very straightforward. It's still pretty chill. So now let us get into the plays. So right off the bat, this is one I mentioned in passing yesterday. I wish I gave it as much attention as I did Meta, but if you have been watching the watch list over the last couple of weeks here, I think it was last week, we were saying Intel, it's going to have a major pre-earnings run right before earnings, and then I don't know what's going to happen with earnings, but now Intel, I believe it's up like 12 or 15% just in the last 48 hours in terms of trading. That's a huge move, and purely, I believe this is that pre-earnings run-up. So keep your eyes out for it. Do I think there's a play? Yes and no. You had a play this morning. We grabbed some options. I went for it first thing in the morning. Thankfully, we hit the likes. I told you guys right away. We'll go over that play here in a second, but by the end of the day, those plays went up about 50-60%. So unfortunately, I would wait till these contracts slow down if you want to get into it. The real move was Friday. You had a second chance late effect this morning, but now with all those options up, both short-term, longer out of the money, or further dating, they are all juicing. You'll see when we get to the play, but watch out for that. It was an absolutely massive move, and we added some to the long-term a couple months ago, so that one is looking nice, but I'm sure that'll all change by earnings. But that is play number one. Then coming into play number two, I feel like you haven't seen this one on the list. I talked about July 4th intervention, and guess what? We didn't get it, so watch out for the yen. They literally went about a week and a half without intervening after hitting a new historic low, and then even all of our data, so maybe they're going to wait for our CPI, or they'll just wait till we have Powell at the end of the month. But I would keep an eye out on the yen, either between now and when we get Powell on July 31st, there will be a gigantic yen intervention pop, but for now, it's kind of been the longest we've gone without hearing about it, so just keep your eyes out for it. It's definitely going to be one of these plays if you do start seeing it wake up. So watch out for that. That is play number 2. And then finally, this one I may be shooting early. We'll see as we get closer to the earnings, but ARM, I think this is going to be a juicy one for earnings. Why? Because last earnings, it was trading around 116. Today, it hit around 180. We hit a 4,000%er on this one this year already. I think there's going to be a lot in store, whether they do good and then they beat the bar or they miss. You got to be careful if they kind of come in line and then it turns into a marvel. But for the most part, the way this thing moved, I think ARM both directions. This one could be exciting over the next couple of weeks. So I would definitely keep my eyes out for that. But those are the main plays. As far as what I did today, these were all of my actions. So this was the Intel play. I said 8. I think I had at 7 cents, not 8 cents. But this was in the morning. I already thought we were late, but I said, hey, I've been talking about this pre-earnings run-up. I didn't want it to get ahead of me. I went with a decent amount of time just so I could get cheaper options. This is well above 2 standard deviations, and I grabbed this 70 calls for 8 cents. And these are the dirt cheap, super far out the monies. I bought them without a premium, even though the stock was up. And then by the end of the day, they went up 50%. So the plan with this, buy earnings, sell out, make them free. We could either have a free player or sell out of all of them, but I wanted to get my hand in the cookie jar. That was the first play. Then I grabbed 2 Citi August 75 calls for 7 cents. Once again, further than 2 standard deviations. I'm going ahead of their earnings. I've been talking about the banks. I think really the only play is the downside. Why I went with the upside on Citi? Because they're the only value one that is not reaching new highs or higher than 2020. So I grabbed 75 calls, 2 of them for 7 cents. And then Unity, this is another one. They report in 3 weeks. So all of these are tied to earnings to a degree. This stock has been at the absolute bottom. Kind of woke up today. I think there was an upgrade. I figured, hey, let's grab 2 of these calls. It's literally, the price range on this is wild. It's a big mover. I don't really have too much confidence, as much as I think if we get any activity in the market and things go good, I might be able to make these free and then get a free option trade. So those were the option plays that I bought today. Then I closed out my final Nike from earnings. We bought it for 29 cents, sold out for like 560, got a little bit more than 2,000%er. I now have no more Nike puts. That was a great play that we hit. And then I added 50 more Nike on the big long term, 5 on the small account, and 3 on Colt Sister. And why I added it, because if you remember what we were talking about all last week, we were saying give Nike that 3 or 4 days, and then now it could start moving. Well, it had all week. Now it's edging down. I think it'll make its final flush here, then level out, and then we'll be good up until next earnings as it meanders around. I still think it could go down to like 70 or even 68, but I also think that 73 flat could be a limit, and then we see it pretty much dance between $73 and $80 until we get into the next earnings, or until any other retail names start doing good, and then it's able to pop. So those were the main plays. As far as everything else, no, that's it. Still in my gold play, lost gains on that, but still up. I'd still keep an eye out for it. And then same thing with the bonds. I'm still riding one of those ZBs that I got clapped on, and then it came back into the green. So other than that, we talked about the main question, and now let's get into our lesson. We are on chapter 6 or 7, I believe. Yesterday, we talked about the East Asian financial model and discussed why they did better than all the other Latin American peers. Some people blame the government. Some people said that they were favored for the market. Now, today, we're going to talk a little bit about the problems in reforms. And as everybody had to make reforms to structuralism and neoliberalism and all of these trade models from like the 40s all the way to the 80s and 90s. And now a big concept is structural adjustment. So we're going to hear a little bit about the crises, how they responded to them. But like I told you guys yesterday, I thought I'd get into more juicy stuff, but understanding this framework, when we start understanding what happened in East Asian financial crises, what happened to the Europe or the Eurozone in 1993 and all of that, these lessons are going to come up. So I strongly encourage that you pay attention. So remember, anytime I interrupt, that is opinion. Other than that, I hope you enjoyed, and don't forget, we have a playlist with all of these lessons if you ever fall behind. So structural adjustment in the politics of reform. By the early 1980s, governments in many developing countries were recognizing the need for reform. The imbalances generated by ISI created pressure for reform, and East Asia's success provided an attractive alternative model. It took a massive economic crisis, however, for governments to implement reform. We'll examine this crisis in detail in Chapter 14. Here we say a few words about it in order to understand how it produced the wave of reform that swept the developing world during the 1980s. Economic crises struck developing countries during the early 1980s, in large part as a consequence of governments' decision to borrow to finance their budget and current account deficits. Using foreign loans to finance budget and current account deficits is not an inherently poor choice, but two factors made that decision a particularly bad one for developing countries in the late 70s. First, many of the funds that governments borrowed were used to pay for large infrastructure projects or domestic consumption, neither of which generated the export revenues needed to repay those loans. As a result, the amount that the developing countries owed to foreign lenders rose, but the country's ability to repay the debt did not. Second, between 1973 and 1982, developing countries were buffeted by three international shocks: an increase in the price of oil, a reduction in the terms of trade between primary commodities and manufactured goods, and higher interest rates on the foreign debt those countries had accumulated. These shocks increased the amount of foreign debt that developing countries owed to foreign banks, raising the cost of paying that debt and greatly reduced export earnings. By the early 1980s, many developing countries were unable to make the scheduled payments on their foreign debt. As crisis hit, governments turned to the IMF and the World Bank for financial assistance. The international institutions linked financial assistance to economic reform. The World Bank and the IMF encouraged governments to adopt such reforms under the banner of structural adjustment programs, policy reforms designed to reduce the role of the state and to increase the role of the market in the economy. The specific content of these reforms that the IMF and World Bank advocated were shaped by their belief that East Asia's success had resulted from export-oriented and market-based development strategies. In the World Bank's own words, the approach to development that seems to have worked most reliably and which seems to offer most promises suggests a reappraisal of the respective roles of the market and the state. Put simply, governments need to do less in those areas where markets work or can be made to work reasonably well. To this end, structural adjustment sought to change those aspects of developing economies that were most unlike conditions in Asia. Governments were encouraging to create a stable macroeconomic environment, to liberalize trade, and to privatize state-owned enterprises. Macroeconomic stability was to be achieved by transforming government budget deficits into budget surpluses. Governments were encouraged to liberalize inputs by dismantling input licensing systems, shifting from quota-based system forms of protections to tariffs, simplifying complex tariff structures, and reducing tariffs and opening up their economies to imports. So if you're not getting it, they're saying all these structures hit, and then they're saying, okay, if you want help from the IMF or World Bank, you need to change your economy to pretty much meet the market. And this is where they're saying the World Bank said, yeah, look at East Asia. They did well, not because of the state. They did it because how they liberalized things and had less of the state in the areas that worked very well for them. I'm sure it'll talk about it, but this is actually a huge thing because over the years, and even if you look at the past, some people have blamed structural adjustment for why countries kind of operate even how they do today, because after a lot of these crises in the 80s, you had people adopting structural reform, and to meet the standards from the IMF and World Bank, they had to change their economy pretty much forever to meet this. So I'm sure he'll talk about it. But continuing, the IMF and World Bank also encouraged privatization of state-owned enterprise, that is, selling such enterprises to private individuals and groups. The IMF and World Bank argued that reducing government involvement in the economy would foster competition, that the greater competition would in turn help to create a more efficient private sector that could drive economic development. Through structural adjustment, therefore, governments were encouraged to scale back the role of the state in economic development and to enhance the role played by the market. Many governments implemented structural adjustment programs between 1983 and 1995. They began to liberalize trade in the mid-80s. In Latin America, average tariffs fell from 41% to the pre-crisis level of 13.7% by 1990. They began to privatize state-owned enterprises in the late 80s in Latin America. More than 2,000 publicly owned firms, including public utilities, banks, and insurance companies, highways, ports, airlines, and retail shops, were privatized between 85 and 92. They liberalized investment regimes, thus opening the multinational corporations. They deregulated industries and reduced government intervention in the financial system. Structural adjustment programs had a dramatic impact on average incomes in the short run and in the distribution of income in the long run. The crises and the reforms brought about a sharp contraction of economic activity. Income fell sharply as a result in Latin America. Income fell about 8% between 1981 and 1984. In sub-Saharan Africa, incomes fell on average by 1.2%. 3% per year throughout the 80s. The dismantling of ISI also redistributed income from urban import competing sectors to agriculture and export or emerging export-oriented manufacturing industries. In the Gambia, for instance, structural adjustments tripled the prices farmers received for groundnuts and significantly increased prices that urban residents paid for petroleum products, public transportation, water, electricity, and telecom. Privatization and civil service reform resulted in large job losses. In Guinea, for example, civil service was reduced in size from 104,085 to 71,089. In pursuing structural adjustment, therefore, governments redistributed income. Export-oriented producers were benefited from these policies, whereas people employed in the import competing and non-traded goods sectors saw their incomes fall. The economic consequences of structural adjustment drove the domestic politics of reform. Groups that would lose from structural adjustment attempted to block the reforms, whereas those who stood to gain attempted to promote the reform. Governments were forced to mediate between them, and in many countries, governments were heavily dependent upon political support from import competing and non-traded goods sectors. Thus, reforms were hard to implement. Over time, however, the economic crises triggered a realignment of interests, discredited groups associated with old policies, and giving greater influence to groups that proposed an alternative approach. By weakening key interest groups and by forcing many to redefine their interests, the crisis gradually eroded many of the political obstacles to far-reaching reform. Yet, this process took time, as reforms could be implemented only after a new government response to new interests had replaced the governments that presided over ISI. So, I thought there was more to it, but that is a very, very simple view. Again, it says we're going to come back to it in chapter 14, but what I really want you to think about is, again, like, what was that? What were the consequences? I mean, imagine you were shifting in all of the changes they did for import substitution, and then they're saying 20 years later, they found out that, okay, well, maybe we should take this approach that half the world still argues was because of the state. The World Bank says it's because of liberalization, and then they're saying, well, and this is what he doesn't explain a lot, but I think it's going to get to it at a later chapter. A lot of this structural adjustment, it required a lot from these countries. It was saying, hey, if you want a loan, you want a bailout. Again, you could even think nowadays like Italy, and I even think Greece, but other countries, especially in Africa, they really suffered from it because they're saying, hey, we're going to require that you make all of these changes just to qualify for much needed aid. So it did talk about the early days, how people fought against it, and then eventually it led to people needing the changes, but a lot of people would argue that structural adjustment led to some negative consequences and borderline was like an imperialistic tool of the United States in a weird way. So hopefully he talks about that later. Other than that, though, that is the lesson for the day. I hope you enjoyed it. And Chad, that is your watch list, ladies and gentlemen. Make sure Hydra Healthy ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, baby, the calling is in the simple things. Master the simple things, baby. Be entrusted with a little. You will be entrusted with a lot more, Chatadonia. Drink that water. Stay hydrated, healthy, all that good stuff. I'll see you in the AMN. Horn.